It was another terrible day in the stock market. It was particularly concerning since we were up for most of the session today, and then the last hour was just an avalanche of selling where most of the indices were down over 1%. Particularly concerning was the fact that the S&P 500 broke through the lows that it had established back in November. So now the Dow is the only major U.S. equity indice that does not have a 3-month low here in real time. So we'll take a look at all of that. We're going to look at the NASDAQ composite today as well. We're actually showing the first oversold cluster signals on the NASDAQ composite since all the way back in March of 2020. We also have some interesting setups when it comes to individual stocks. With the VIX high here today, I wanted to take advantage of that with our trade application example, where I'll show you how to sell a put on a company that's been raising its dividend for a long period of time due to the fact that it now has an oversold cluster signal of its own on a weekly candle chart and is somewhat near a range where long-term investors can feel a little bit more comfortable picking it up. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 20th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you're signed up for our email distribution list. Remember, not only do you get notification via email when these videos are ready to be viewed, but you also get a sense of what stocks are giving you overbought and oversold cluster signals within the S&P 500, and has been the case earlier this week. I have no doubt that there will be a whole slew of oversold cluster signals here in today's email. In addition to that, we're heavy users of Twitter. I would encourage you to follow me if you're not doing so already. My handle is @BrandonVanZ. And we really appreciate those of you that click like and retweet with these Market Outlook related tweets. Last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And my, oh my, what a disappointing day it was, closing at the lows of the session effectively after being up for much of the day. The last hour was just awful out there, tons of selling. Actually felt worse to me than what we saw on Tuesday. Tuesday's ending percentages lower were actually worse, but today to me felt a little bit worse just because it kind of felt like the market wanted to find some stability in the morning, and it just absolutely is like the dam broke in the afternoon and the water came rushing out and all the sellers emerged once again. So it's been brutal out there, particularly during the last portions of this trading sessions recently. So we've got our heat map pulled up here. This is the Market Scholars 1000. And you can see it is a sea of red here today. We had a lot of the big time players like Microsoft, Amazon, Tesla, Apple, Alphabet, and Facebook or Meta all getting hit pretty hard here today. Remember, those are our so-called generals. The rest of the market you can kind of think of as the soldiers. And it has been kind of those bigger companies. You can also throw maybe, Nvidia in there, perhaps a few of those others that have been holding this market up for the last several months. But what we've seen is a obvious transition here in the last couple of weeks where that is no longer the case. Those companies are no longer immune to the selling. They are getting caught up in the chaos just like all of the other smaller companies out there. So as you can see, there weren't a whole lot of places to hide out today. I am happy to report that one of the very few places that was able for you to be hiding out was Chinese internet companies, in particular Alibaba. Of course, the trade application example from the video I did for you guys 2 days ago, always interesting to see the feedback, but I received an email from somebody who very much disliked that particular trade idea. And as I mentioned in the video that day, 2 days ago, if you don't like it, stay away from it with a 10-foot pole. Clearly there are risks associated with that, and I tried my best to outline some of those risks there. But no need for you to email us when you dislike dislike our trades. We understand that we're not going to hit 1,000% out there, and that many of you will disagree with our trades every single day. That's the nature of the markets, and there's always buyers for sellers and vice versa. But I am happy to report that thus far, that trade has worked out nicely, and Alibaba was actually one of the very few companies that managed to close in the green here today, up nearly 3%. You also saw its competitor JD.com up here today. You saw Pinduoduo, another one of those e-commerce giants in China, also up. Speaking of China, you also saw that Baidu managed to close higher today. So there does seem to be maybe a little bit of strength there overseas in some of those emerging markets. But right here in the good old US of A, it was a bloodbath. We didn't even have the staples helping us out today. A lot of times we have these types of days and you can say, well, there's a little patch of consumer staples that it's trying to hold up. But today we didn't even get that. Walmart and Costco and Pepsi, Coca-Cola, Procter & Gamble, they were all down today as well. You did have Philip Morris and Altria up today. We actually talked about those two companies to a degree in my question and answer session earlier today, but those old school tobacco companies managed to close in the green. And then we did have a smattering of utilities that managed to close in the green. The biggest one being NextEra Energy was up over 1%. But otherwise, you can see it was real hit and miss. You had to get kind of lucky to be landing on one of those green squares out there on a day like today. And again, the percentages weren't terrible, but it was just the awful feeling of that avalanche of selling into the close. It leaves you with the feeling that all else being equal, you might get further selling tomorrow morning. And on that point, I have some bad news there as well, because this afternoon, after the normal market closed, Netflix came out with their earnings and is getting absolutely annihilated. Right here, you'll see that Netflix was down 1.5% in the normal session today, but that does not account for what is happening after the bell. Netflix, the last I checked, was down 20% after hours, and so that bled over to other streaming companies like Disney. It's also down after hours. You're probably going to see some of the other media companies like Viacom and some of those down as well. So be on the lookout for some ugliness coming out of the communication space first thing tomorrow morning, courtesy of Netflix. So wish I had better news to share with you, but there just wasn't many places to hide out today. It was a bloodbath across the board. Speaking of which, remember another way that we can kind of gauge the market breadth on any particular day is by looking at this Market Watch Visualize tab. And that will basically give you a chance to get a sense of how many stocks in the S&P 500 or other index that you choose was up or down. And in this case, I've got the S&P 500 index pulled up, and you can see that today there were 80 advancers, in other words, stocks that closed positive in the green, and there were 420 that were in the red. Now, again, that wasn't as bad as what we saw on Tuesday. When I was last with you, I think that the percentage was, it was an 89% day for the bears there. Today, it was only 84%. I use that loosely because, of course, 84% is still terrible. But point that I'm trying to make is, from a breadth perspective, you actually found that Tuesday was worse than today. But again, I need to stress that I think it feels worse to me today because of the way that it shook out. It wasn't one of those days where you expected it to be down the whole day and you kind of just lived with it throughout the session. Today was one of those days that gave a little bit of sunshine, a ray of sunshine to the bulls out there, and then just completely pulled the rug out from under them in the final hour of trading. So while some of the statistics may not be quite as eye-popping as what we saw on Tuesday, I think the sentiment out there, the feeling of the market is equally as bad, if not worse. Moving on now to our normal charts. Here's the 4-grid that we typically will use. In fact, I just posted this to Twitter here not too long ago because I wanted to show you there, at least those of you that follow me on Twitter, that all of the sudden the S&P 500 has lost its previous low. I don't think this morning people were expecting that. You can see what today's candle looked like. In fact, let me right-click and go to maximize the sell here. And you'll see that this is the third straight day of selling for the S&P 500. Notice a common theme. In fact, we could go as far as saying that 4 out of the last 5 days were a common theme of that selling. very ugly candles. So in other words, aggressive selling days. Notice that the label up at the top where it talks about the daily range is orange. Remember, when you have quiet days, that label up there is blue. But when you have a day like today where we went 124 points from high to low, that was bigger or larger than the average true range that is typically 63 points from high to low in this more recent time period. So not only were 4 out of the last 5 days down days, but they were aggressively down days. And to make matters worse, notice how nearly all of them closed near the lows of the session, if not directly on it. So in other words, very little lower shadows underneath those candles. And so, as you've heard David and I say many times throughout the years, you want to be looking for those long lower shadows, because it's a sign that the bulls are trying to kind of pick up the pieces, stand their ground, and kind of push the bears back. And right now they have not been willing to do that. Right now the bears are winning the day because they are closing the market at the lows. But what I wanted to point out was that in all the chaos in today's selling, people might not have realized until looking at the charts that we took out that 3-month low on the S&P 500. Take a look at where we were at here, end of November, beginning of December. The lowest point we got on an intraday basis there was on this candle, where we didn't close, but we were trading as low as 44.95 on the S&P 500. Today we closed at 44.82, a full 13 points lower than that low is where we closed here today. So we have broken that support. If it wasn't enough for us to be looking at the broken support up here of the moving average itself, now it's clear as day that we have broken support all over the place. We're literally at the lows of the last 3 months here on the S&P 500, and this has happened quickly. Remember, that's often the case. A lot of times markets take the steps up and the elevator down, and we're part of that elevator ride right now. Now, naturally, we have had bearish posture on the S&P 500 largely since January 7th. On that day, you can see the color background changed to that pink color. So we did have one exception to that. One day we managed to switch back to bullish for just one day here where it was trying to bounce, but then the very next day we reverted right back to that bearish posture. So this is nothing new. We've been experiencing this since January 7th, and we have had those bearish postures along the way. You can see that the S&P 500 was down 1.1% here today. And the other thing that I should point out that's a little bit different from when I was last with you on Tuesday is that we not only have a strongly bearish intermediate posture now, but we also have found that moving average has rolled over. Remember, when I was last with you on Tuesday, the moving average color was yellow because while price was below it, the moving average was still rising. Now, with 2 more really ugly selling sessions since then, it's done enough damage where the moving average itself is now curling lower. Now, sometimes it's a very fleeting effect. You'll notice that back here, as an example, it only occurred for one day where you had that red moving average, and then another one day right there. And then here you had it for 3 days. Well, I hate to be the bearer of bad news here, but I don't think this one's going to be changed anytime soon. And the reason for that is how far below we are below that moving average right now. Right over here, we weren't all that far away, so it was relatively easy for us to get back above it. This time around certainly feels different. Whether it will be is anybody's guess. We'll all find that out together. But my sense is that it's not going to be reverted very quickly. You might have a few snapback rallies here or there, but to get all the way back above that moving average is going to take a monumental effort at this point. So could we get there within another month or two? Of course, but is it going to happen quickly within like 3 days, like we saw back here? I don't think so. Obviously, anything's possible, but it's precarious out there. Remember, this is also options expiration week. Tomorrow we have a lot of options contracts rolling off the board. Sometimes you can get a bit more aggressive days as a result. The two sold puts that I did for the market outlook video will both expire likely tomorrow at max gain. That was the Bristol Myers trade and the Leggett and Platt trade. So fortunately, we gave ourselves enough wiggle room with our sold puts where we shouldn't run into any sort of a buzzsaw unless we really have a market crash tomorrow. But I have a feeling there's a lot of other people in pain out there when it comes to some of their positioning with their options contracts. So you might see market makers kind of press into that pain to a degree tomorrow as well. And of course, tomorrow being a Friday, sometimes you see that, avalanche of selling into the weekend because people don't want to hold their positions over the weekend. So tomorrow should be an interesting day to say the least. But what we do know here is that we have strongly bearish intermediate posture on the S&P 500. It is trading below its falling 30-day moving average, and you have broken support levels all over the place as we are now trading at 3-month lows. Now, we're not quite to an oversold cluster signal because remember, there is a theory that sometimes it's so bad it can become good, but we're not quite there on the S&P 500 yet. Remember, we would see those little green dots show up. We'll talk about that here in just a little bit with the NASDAQ and the Russell 2000, but we're not there on the S&P 500 quite yet. Dow Jones, it was only down 0.89% today, so just like I have been saying for weeks at this point, the Dow Jones remains our relative leader, and that is what you should expect when you see aggressive selling like we found here more recently. It's not that the Dow has some magical ability to withstand selling pressure at all, it's just that you assume that blue chips will go down less than your more aggressive growth and more speculative types of securities that are out there. So while it was a bad day for the Dow as well, it still is outperforming the rest of the markets that are out there. You can see that the Dow, similar to the S&P 500, now has that strongly bearish posture along with trading below its falling 30-day moving average. This is actually the 5th straight day of selling for the Dow. We got lucky there with that day on the S&P 500, but the Dow wasn't as fortunate. So this is actually 5 days in a row for the Dow. And remember, you don't see that very often. On this whole 3-month chart that we see here, there was no other example that I could show you where we were down 5 days in a row. We were down 4 days in a row right here, but this is the first 5 day in a row downside action that we've seen on the Dow Jones Industrial Average in the last 3 months. So it's not good out there, but going back to that image I shared on Twitter, another way to identify that the Dow is currently the relative leader in this market is the fact that it is the only one right now that is not trading at 3-month lows. You can see the low on the Dow was here at about 34,000 back here on December 1st, and we're still trading about 700 points above that. But still, I don't want to sugarcoat it. It was still bad for the Dow today. In fact, we were up, I want to say it was like 400 points on the Dow at one point during the session today, and we ended up closing down 300 points. You can see that the daily range today was over 800 points. So this was a massive day. It was double the range of trading today than the typical average true range of the recent time period. So again, that's where today was highly disappointing because it looked like it was going to be a winning day for the bulls, and then all of a sudden the bears just pulled that rug out. So new information there as well on the Dow, where we now have that strongly bearish posture there. Now on to the bottom two charts. Remember, those have been our problem children. They've been the underperformers for a while, and they continue to be our laggards. Notice that the NASDAQ composite was down 1.3% today. Russell 2000 was down 1.88%. Again, those numbers are better than what we saw on Tuesday, but the fact that we've had continuing selling since Tuesday and the fact that we were up on both of those early in the morning and then closing at the lows effectively just left a terrible taste in your mouth. Take a look at how the charts look on the NASDAQ and the Russell 2000. Things are ugly out there. Notice the difference between the 30-day moving average with where we are trading right now in the NASDAQ. This is by far the worst amount of separation between those two levels that we've seen in 3 months. And you could probably get away with saying the same thing here with the Russell 2000. Here you also had a pretty big separation back here on December 1st from the moving average with where it was trading. That, by the way, was also a day that you got an oversold cluster signal. In fact, prior to the last 2 days, if you were to look at all 4 of these charts, the only oversold cluster signal that we had was this one right here on December 1st for the Russell 2000. Fast forward to the last 2 days, however, you can now see that we have oversold cluster signals for both yesterday and today on both the NASDAQ Composite and the Russell 2000. You've got those little green dots that show up down below. If I were to right click and go to maximize the chart, notice we've got that green dot and that green dot. So it lines up with that green dot and that green dot on the price action up above, effectively saying that the green, the blue, and the red lines on the market forecast technical indicator are all in the lower reversal zone at the same time. Now, what that identifies is not necessarily a point where you assume that we will go from being in a downtrend to being in an uptrend. The way that I think about those clusters is whatever condition led you into those clusters is unlikely to repeat itself in the exact same time afterwards. So in other words, these last 2 weeks have been pretty much straight down for the NASDAQ and for the Russell. So by looking at these clusters, it is my assumption, and my assumptions can be wrong, of course, but it is my assumption by finding those clusters that the next 2 weeks will not be nearly as bad. Now, again, markets are crazy, right? So anything can happen. A nuclear bomb could go off in some part of the world tomorrow and, it wrecks all of your technical analysis. But assuming normal back and forth type of trading, that is, I suppose, the good news here is that it is so bad out there that you now have oversold cluster signals, and it's unlikely to continue at this pace in the coming couple of weeks. Now, does that necessarily mean that we get a huge rebound from here? No, it doesn't. Could it mean that we just go sideways from here to wear off those oversold conditions? Yes, that's entirely possible. So I tend to look at those oversold cluster signals as opportunities to do things like selling bull put spreads, or in the case of stocks that I want to own, selling puts themselves on them. But remember, that provides you a bit more flexibility. If you wanted to be really aggressive, you'd be doing things like buying calls and buying the stock outright. But I don't think that's necessarily what these clusters are designed to do. In other words, they can equally go sideways. They could go up a little bit. They could even go down a little bit. They just won't go down at the same pace that they've been going down in the last couple of weeks. And so you need a kind of a forgiving trading strategy in order to take advantage of that. And that's where the selling the bull put spreads and selling puts by themselves on individual stocks can sometimes be useful. So anyway, I found that to be interesting that we now have our first examples of oversold cluster signals for the first time in a couple of months in the case of the Russell 2000, and really for the first time in several months for the NASDAQ Composite. Let me right-click on the NASDAQ because I'm just curious for myself here. If I were to change this from a 3-month chart, let's go to a 6-month chart instead. Yeah, we can say that they have not had an oversold cluster signal in a half a year. And let's go to a 1 year and see if they've done it in the last year. We can say that they have not done it in a whole year. This is the first time the NASDAQ is doing this, right? Again, I'm looking down below and I'm looking at those little green dots. Remember, on the out of the box version of the market forecast, you're not going to see those green dots. But if you're a premium member of Market Scholars, we offer you access to all of our premium charts. So that's one of the clear example benefits of that. And I can quickly see with my eye that these are the only green dots in the last year for the NASDAQ Composite. So that is noteworthy. Remember what I've kind of worked with you guys on in the past where, I've kind of brought up the phrase, the boy who cries wolf, on some of those securities that are constantly giving you overbought or oversold cluster signals. This is a good example of an index that hardly ever gives you oversold cluster signals. There's been a few overbought ones along the way with those red dots, But these oversold cluster signals are incredibly rare. The last 2 days are the first time in an entire year that the NASDAQ composite has had them. So in other words, they become more noteworthy to me, not less. They become more interesting to me to think about those bull put spreads or selling puts, that type of a mindset there. I'm curious if I were to go back even further. Now here I'm not going to go to the 3-year because that would show me the weekly candles. What I want to do is I want to actually change this to 2-year, but leave the aggregation period on days for this part of the conversation. And you can see that the last time we had oversold cluster signals on the NASDAQ composite on daily candle chart, you would have to go all the way back here to March of 2020. Now that should sound familiar to you. That was in the teeth of the worst sell-off we've seen in the stock market since 08-09. That was in the coronavirus meltdown mode. That happened on March 12th of 2020. You can see this little green dot shows up down below, associated dot up above on the price target or on the price chart itself. And you can see that while that didn't call the exact low was about 1 week later. I think most of us, if we had the opportunity to turn back time and buy the NASDAQ composite on that day where it closed at 7,200, we would be quite thankful for that, because despite what has felt like immense selling that has happened in the last few weeks here, 7,200, if you were to double that, is effectively where we're trading right now. In other words, you still have a double, 100% return on this index in a year and a half. So that just goes to show you how terrible things have been here recently, where these are literally the first cluster signals on daily candle charts since going all the way back to that worst part of the selling in the coronavirus meltdown, March of 2020, for the NASDAQ composite. So this is noteworthy, to say the least. So ugly trading out there. And these charts prove it. And now the question is, when is it so bad it becomes good? And it kind of feels like you still need a further flushing out event. It doesn't feel like we're there, right? If you were to think about it, we're still not all that far away from all-time highs, right? It would be another thing if we were already down 20% from the highs, but we're not there yet. So it kind of has this uneasy feeling like we need a further washout before it's all said and done. So we'll keep you posted, as we always do during these videos. Things are changing constantly, which is why it's important for you to check out these videos as often as possible. All right, let's go ahead and pop on over to the internet briefly. I always like to get a chance to say thank you to those of you that help support this video. Remember, David and I don't make a dime for doing these videos, yet they do soak up several hours of our day, Monday through Friday, when we're doing them. So we ask one simple request out of you. If you appreciate the videos and if you want to hear from us daily for free on YouTube, we simply ask you to help support it on Twitter. Just click like for us on Twitter. That's your best way of saying thank you. So I appreciate the 107 of you that took the 5 seconds out of your day to click like for me there the last time I did it on Tuesday, which is why I'm doing a full-length video for you here today. Anytime we're up and over 100, I'm happy. We'll do a full-length video, including a trade application example. If we're below 100, then that's your opportunity to have a kind of a quick hitter, 15-minute version of the video that only concentrates on the indices themselves with no trade application example. So if you want these longer form videos, keep clicking like. If you prefer the shorter form videos, then don't click like for us there on Twitter. Also, earlier today, I taught my question and answer session. We had a great 3 hour and 20-minute session there today with our premium members. And then David taught his portfolio management with ETFs class earlier today as well. Tomorrow, he's got his technical analysis class at 1 p.m. Eastern time. I'm sure he'll do a fantastic job with you guys, as he always does, where he is kind of reading the tea leaves of the market and giving you his thoughts, his opinions, and his insights based upon his experience over the years as to where this market is heading. I mentioned my question and answer session earlier today. If you are a premium member, remember you have the ability to work directly with David and I and ask us questions, and we will give you our honest opinions on things. And so I got a question asking about Unilever today as a dividend growth investment, given their recent news with GlaxoSmithKline. I got a question about Ally Financial, which is a financial company that's just been growing their dividends like gangbusters here recently. I got a question question about how to set up your Thinkorswim platform so that way you can help identify the 1% return on risk on sold puts. I got a question about dividend growth investing stocks from the 70s and 80s. In fact, I posted a number of charts on Twitter earlier today from stocks like Coca-Cola and Procter & Gamble and 3M and IBM and Bristol-Myers Squibb and the like from back in the 80s and 70s. For those of you that want to check that out, you should be able to find that on my Twitter feed. I put it all in one thread there. I got another question about Ford. I got another question about, how do you handle selling puts if you have smaller account sizes, and how do you think about position sizing and things like that. So anyway, if any of those topics seem of interest to you, feel free to check that out. And then I got one final question here about understanding the difference between how do you use position sizing on trades versus investments. So lots of good stuff for you to sink your teeth into over the weekend if you didn't get a chance to join me there live earlier today if you are a premium member. Also, posted the factor selector tool to our website here earlier this week. Remember, this gets posted on Wednesday morning, but it's using Tuesday night's closing information. Not a whole lot to report to you here on this because we didn't see a lot of change here this week over week. Value stayed number one and momentum stayed dead last. Dividend yield, by the way, managed to hold up there pretty well and maintain its number two positioning. Now, speaking of which, let's go ahead and transition back to the paper money account now. I wanted to show you our 6 grid that we use for that factor class. And as you can see here, it was an ugly day of selling across the board. All 6 of these factors were selling off here today. However, there is one chart here that is standing out to my eye as being slightly better than the rest, and that is the dividend yield factor. That's your chart in the upper left. While we have sold off 3 days in a row, note that it is still sitting right atop its 30-day moving average. All of these other factors have cut through it, including value. So it is possible that, given what I just showed you a moment ago on the factor selector, that if these current trends hold true, it's possible dividend yield could take over as number one on the factor selector as soon as next week. We'll see. There's a lot of trading between now and then, but just wanted to point that out because this is a little bit of new information we are learning here, that even the value factor fell pretty strongly today. Some of the commodity areas are actually holding up reasonably well, but it's the financials within the value factor that I think are really weighing on that factor right now. Many of those financials have been getting hit after announcing their earnings here in the last week or two. So remember, it's the oil and gas stocks along with the financial stocks that make up the biggest sector allocations within value. For a big chunk of earlier this year, both financials and energy were doing really well, so value as a factor was doing really well. The last 3 days, what we've seen is a lot of those financials really starting to sputter, and so now you're finding that value is not holding up quite as well. In terms of the other 4 factors, you can see it's a bloodbath out there. All of them are basically trading at their 1-month lows. The worst of the bunch remains momentum. You can see here momentum has now been down 5 days in a row and was once again closing near its lows of the session there. So not a good look there for momentum. So not a lot of good places to hide. If there's any kind of semblance of capital preservation out there, it is happening in kind of those blue chip securities that would make up the dividend yield factor. All right, let's go ahead and take a look now at our 12 grid, which is chart 5A. And this will be our asset class 12 grid to give us a sense of what has been happening here more recently. And what should stand out to you when you look at this is at the bottom rung, all 4 of those charts on the bottom are green. All of the rest of the charts are red. On the bottom here, we have the US dollar. Remember, we talked about that on Tuesday, having a couple of really big moves ever since putting in its own set of oversold cluster signals. It has continued to remain somewhat resilient here. I'm still a little bit standoffish regarding it because it's still above its, it's below its 30-day moving average in this case. So I'd like to see it overtake that. Right now, I just don't know if it's got the oomph to get up and over it. But these other charts are all looking quite strong. You can see that gold was up very handsomely yesterday. Pulled back a touch here today. Part of that might have been because the dollar was strong, right? The US dollar was up 0.31%, so commodities, all else being equal, are often down. And so that was the case with gold today and also oil. Oil has been kind of acting more so like an economic barometer, or perhaps it's just acting a little bit differently than other commodities like gold. At least that's the way it seemed to me. You can see that oil has been up here near its 3-month highs. And despite gold breaking out nicely yesterday above some of its prior resistance in the last couple of weeks, it's still below its highs from a couple of months ago. So oil has been stronger up until this point. Both of them were down today, but both of them remain with strongly bullish intermediate postures above rising 30-day moving averages here. You can see that the 10-year Treasury yield remains in a bullish mode here as well. You can see here that it did have an overbought cluster signal a couple of days ago and has maybe pulled back a little bit from those extreme readings, but is still up there near 3-month highs. So we're at 1.83% on the 10-year U.S. Treasury yield right now. Remember, I do have a bull put spread going on TLT as it stands. TLT was actually up pretty nicely today. Reason for that is TLT is oftentimes viewed as a safe haven of sorts. Remember, they're U.S. government bonds, and when the stock market gets really highly paranoid, sometimes it transitions into U.S. government bonds, even if they are yielding a pittance these days. All you have to do is look back on the TLT chart to like 2008 and 2009 to see what I mean. Even in the worst of the sell-off in the stock market, Treasury bonds were attracting a bid. So I think that was part of the reason why we found that TLT was up here today, is just because there was so much chaos elsewhere. Money needed to flood somewhere, and it went into where it perceives to be a safe haven of those U.S. government bonds. So pretty nice move there out of TLT, and I was happy to see that because remember, we got that bull put spread going. We want TLT to stay above 139. We're basically at 142 right now, so we're still in an okay position, but obviously this is still a pretty ugly looking chart, so I'm not counting my chickens before they're hatched in this case because it's still pretty precarious here. But we did have that oversold cluster signal again a couple of days ago there on Tuesday, as I mentioned at that time, and we have risen 2 days in a row since then. You can see that we had some pretty ugly selling there in the high yield bond market today. Notice that we closed near the lows on high yield bonds, perhaps somewhat correlated with the fact that the oil prices fell today as well. Bitcoin stumbled yet again. So, back to that, boy who cried wolf philosophy that I'd mentioned before. That's where this stems from, right? This is the boy who cried wolf. Over and over and over again, giving us these oversold cluster signals. I think of the NASDAQ composite itself as entirely different than Bitcoin from that specific perspective. They're both risk-on securities, but in the NASDAQ composite's case, it's been a year and a half since you had an oversold cluster signal. Bitcoin is tremendously volatile, so the more volatile the security, the greater the chance is that you're going to get oversold and overbought cluster signals. So I'm not reading too much into the fact that we got yet another oversold cluster signal on Bitcoin, because these last ones, they haven't really been responded to. But just an acknowledgement that it is true. Bitcoin is not a safe haven, despite what people will have you believe. It will perform well in certain market environments and poorly in others, just like a lot of other risk-on securities. It is new, it's exciting, it could very well be the future for all I know, but the way that the market is perceiving it right now is that Bitcoin is not a safe haven, the way that you would think about gold. Remember, there was a lot of chatter about that before, that Bitcoin is the new gold, it's the digital gold, and it's going to take over as the safe haven status. And what we've actually seen is that Bitcoin is a risk-on security, and you get a lot of alpha in both directions, up and down, depending upon whether the market is willing to take risk at any moment in time. And right now, the market's not willing to take risk, and so Bitcoin has been sold off hard as a result. You'll see up here on the top rung that we did have the emerging markets as one of our rare bright spots. I addressed that a little bit earlier when I was talking about Alibaba being one of the few companies up here today. But other Chinese companies like Pinduoduo and JD.com and Baidu were also up. So I think that kind of helped EEM manage to close higher by 0.59% today, whereas the developed foreign stocks and, of course, the United States were lower. Since the U.S. was lower by more than 1%, sometimes it's helpful for us to also look at the daily percentage moves chart. And so this is chart 6D, and you can see that this red bar was below the blue horizontal line yet again. Now notice this has happened repeatedly recently. You've actually had, out of the last 5 days, 3 out of those last 5 where the red line has gone below that blue horizontal line, meaning that we had at least a 1% move. And yesterday was awfully close. We didn't quite get to the blue line, but we were nearly there. We were actually there at one point during the day, but we bounced slightly before the close. So point is, we've lost about 4 or 5% in the last week itself in this slide that we've seen here. So it has been a difficult stretch without a doubt. Also note that the VIX was up nicely today. The VIX closed approximately at 26 here today. Remember, when the VIX goes up, it's typically inversely correlated to the rest of the stock market because it's known as the fear index. And it's basically, suggesting that people are buying lots of puts to protect their portfolio. Now, when we get chaotic days like that, I tend to be on the opposite side of the coin. I'm interested in selling puts when the VIX is high, right? The idea, some of you have heard the phrase, buy when the VIX is high, and what they mean there is typically when the VIX gets high, the stock market is low. And if you like buying stocks when they're low, then you should buy when the VIX is high. Of course, the challenge is you never know how high is high enough, right? Because we saw that, for instance, back here in December, the VIX got as high as 31, which is still higher than where we're at right now. So that, of course, is a tough thing to judge. But again, one of the nice things about selling puts is it provides quite a bit of flexibility towards you because it provides you some wiggle room, some cushion for you to be wrong in case your timing is not precise. So that will transition us into our trade application example for the day, where I wanted to pull up chart 2A. This is our dividend stair-step chart. Now, just a reminder that when we're looking at this, I'm gonna pull up the ticker symbol in question, which is BBY. That's Best Buy. Remember, that's not Bed Bath & Beyond. They got fairly similar ticker symbols. This is Best Buy, BBY. And this is actually known as a fairly decent dividend growth stock throughout the years. It's got a fairly long history of raising the dividend. I know you probably wouldn't think of it at first blush because it's not Procter & Gamble or Coca-Cola, but they do in their own right actually have a pretty good streak under their belt that stretches back maybe 10, 15 years or thereabout. So when you're looking at this chart, there's a lot that goes into the calculations. These are proprietary numbers that we calculate up here at the top that form these lines. But the main takeaway that you'll want to know if you're newer to it is that the blue zone is what we would perceive to be undervalued territory for a dividend growth stock. And the orange zone up at the top would be what we would perceive to be overvalued territory. So naturally, if you want to be a long-term investor, you want to buy stocks when they're on sale. My battle cry is, buy high-quality merchandise on the cheap. So fast forward to where we're at right now with Best Buy, you can see that this stock was all the way up here at about $142 as recently as mid-November. This thing has collapsed, about $40 or $50 per share since then. It closed today just under $95. Now you can also notice something else that's showing up on the chart. We've got this little green dot that appears under today's bar, just like we saw, I should say this week's bar. Let me correct myself there. These are weekly bars that we're looking at here, not daily bars, weekly bars. And we also had a similar weekly bar cluster back here on December 20th. Now, that's still operating under the market forecast system that I was explaining here before when we were talking about daily clusters on something like the NASDAQ composite here today. These weekly clusters are even more rare. it requires a very, very big sell-off before you see them. And sometimes they work pretty nicely in determining where a bottom is about to be formed. You can see throughout history we had this set of oversold clusters on a weekly candle chart in late 2018, and that would have been an interesting time to be a buyer of Best Buy in this case. You can also see we had a green dot back here in December of 2015. We also had green dots here in August of 2015. Again, might not call the exact bottom for the stock, but it was in the vicinity of that bottoming territory. And if you had the opportunity to buy Best Buy back here when it was trading at 30 bucks a share, you probably are happy about that today when it's trading at 95. You can also see we had some of those oversold cluster signals on the weekly candle chart back here in 2014. April of 2014 to be exact. Again, same thing. Would you want to be a buyer of Best Buy at $23 per share? Despite collapsing in the last couple of months, you're still up tremendously from those levels here in real time at 95 bucks. And then you also see this patch of oversold clusters here in late 2012 when the stock was trading at approximately $12 per share. So the point that I'm trying to make is these clusters that we see here in real time don't necessarily have to guarantee a bottom around these levels, but in general, I would say that they have done a reasonably good job throughout the last 10 years suggesting that a bottom is somewhere in the vicinity, right? You're not at the exact bottom perhaps, but you're trying that process of forming a bottom. So this blue line down below would be where my dividend growth investing class would be interested in purchasing this for the long term. You can see that had you been buying it at the blue line back here in the coronavirus meltdown at around 55, you'd be pretty happy about that today. You also would have been pretty happy about buying it as it touched this blue line here in December of 2018 when it was 48 bucks, and back here as well as back here. So that blue zone is an area where we'd like to put on a new long-term position. Now, obviously, we're not there yet, which is why today, instead of just buying the shares outright, I did what was known as selling a put. And the hope with selling a put is that this company is at a level of stability as opposed to a constant collapsing like we saw a couple of months ago. And if it does go lower, it goes lower more gently moving forward. And if you sell a put, and what I did is I sold the March 75s, what I usually teach my students, where I teach the put selling class on Monday afternoons, where we haven't had a single losing trade for 2 years at this point. So we've had a nice track record there. There's one in our account right now where we might have some challenges moving forward, but we've had a really nice run of things. But the way that I teach that class is to look for about 20 to 60 days until expiration. So right now that opens us up towards the March contracts. And so I am selling the March $75 puts, and you can see that that blue line right there is approximately at that same area. The blue line is precisely at 75.68. The other thing I would add to it is Best Buy has now paid their fourth dividend in a row at 70 cents, and they are a company that typically announces a dividend increase every year. So in other words, the next dividend announcement they have will likely be an increased dividend announcement, which means that that blue line will actually be going higher in the future in all likelihood than 75. So in a way, it's even a more conservative approach by taking it the way that I am right here. So I was able to get over 1% return on risk for selling the $75 put there on Best Buy in the month of March for the purpose of recognizing the oversold weekly cluster, in addition to recognizing that that is the level where long-term investors have been rewarded historically to take ownership of that particular stock. So that's what I had for you here tonight. I hope you enjoyed the presentation. It was an ugly day in the market. Don't kill the messenger, right? I'm just here reporting upon it. It's been ugly out there. but we'll continue to do our best to help support you. Hopefully we can find bearish trades along the way to help you, or even do bullish ones like I did with Alibaba on Tuesday that could kind of buck the overall trends there. But in general, we hope you are learning from these free videos out there. And as always, we ask one simple thing in return. If you like these videos and you want us to continue to do them on a daily basis for free on YouTube, just simply click like for us there on Twitter. If we're up and over 100 likes, I'm happy to do it for you. If we're under 100 likes, then I'm less inclined to give up all those hours of my day. So with that, I want to wish you all the best of success with your trades and your investments. Enjoy your NFL playoff games this weekend, and we'll see you all early next week. And David should be back with you here tomorrow night.